The greatest deception perpetuated in modern markets transforms institutional communication into personal failure, convincing traders that volatile price action represents their inadequacy rather than the composite man's deliberate examination process. This narrative proves so pervasive that profitable participants abandon sound analysis the moment apparent chaos emerges, never recognizing that what feels like sabotage actually represents the most systematic verification process ever devised by professional capital. Wyckoff observed that smart money operates through calculated necessity, not random cruelty. Before deploying significant capital, institutions must verify that the path of least resistance remains clear, that opposing forces have been neutralized, and that retail participants lack the conviction to interfere with their objectives. Every dramatic sell-off below established support, every false breakout above resistance, every grinding consolidation that exhausts patience, serves this singular purpose of institutional due diligence. The tape speaks in the language of effort versus result, where large volume producing minimal progress reveals absorption on the other side, while significant price movement on suspiciously light volume exposes hollow commitment, springs beneath support levels, and upthrusts above resistance represent diagnostic probes, not theatrical displays. When price violently penetrates a range only to snap back with a narrow close, supply exhaustion becomes evident to those who understand the examination's true nature. When breakouts die immediately on expanding volume, demand reveals itself as manufactured rather than genuine. This reframing transforms the trader's relationship with market volatility from adversarial to collaborative. The account destruction that felt like personal attack was institutional verification of weak hands. The false breakout that triggered stop losses was smart money's confirmation that retail participants remained trapped by hope rather than guided by logic. The endless sideways action that forced position abandonment was patient accumulation of cause before effect, visible only to those who recognize testing as invitation rather than punishment. Mastery begins when pain becomes information, when the question behind each movement grows clearer than the movement itself. The market tests everyone's conviction at critical junctures, but only those who interpret these examinations correctly can position themselves alongside institutional interests rather than against them. Recognition of this truth ends the helplessness that transforms profitable traders into victims, replacing confusion with systematic analysis and hesitation with disciplined execution. Wyckoff's law of effort versus result stands as the foundational principle underlying all sophisticated market analysis, providing the analytical lens through which apparent chaos resolves into systematic institutional communication. This cornerstone insight demands that every price movement be evaluated in direct proportion to the volume that created it, where effort manifests as trading activity and result appears as price progress. When these elements align harmoniously, natural market forces drive legitimate price discovery through genuine supply and demand interaction, revealing the path of least resistance that professional operators seek to exploit. The law's diagnostic power emerges through deliberate divergences that expose the composite man's examination process during critical market junctures. When massive volume produces minimal price movement, absorption occurs on the opposing side of public sentiment. At established support levels, heavy selling pressure that fails to penetrate the range reveals quiet accumulation, where professional operators systematically gather inventory while retail participants surrender positions into apparent weakness. Conversely, at resistance zones, surging volume that cannot force price extension exposes distribution activities, where institutions transfer shares to eager buyers whose demand proves insufficient to sustain higher valuations. The comparative nature of this analysis transforms isolated price bars into testimony under cross-examination, where current effort and result must be measured against previous attempts at identical price levels. A breakdown that previously required substantial volume, but now occurs on diminished effort signals supply exhaustion, while rallies that once traveled significant distances on moderate volume, but now stall despite greater effort, reveal increasing overhead supply. This temporal comparison provides the analytical framework that separates systematic interpretation from emotional reaction to individual market movements. When significant price movements occur on conspicuously light volume, the law reveals these as testing probes rather than committed campaigns. The composite man engineers these effort result anomalies strategically, using reduced volume to probe below support during accumulation phases, confirming that supply has been exhausted without triggering widespread selling pressure. During distribution, light volume rallies test resistance levels to verify that demand remains inadequate for sustained advancement, allowing institutions to gauge retail conviction without committing significant capital to the examination process. This systematic approach replaces the confusion that transforms institutional testing into personal attack, establishing objective criteria for interpreting market behavior through professional perspective rather than retail emotion. The law provides intellectual safety through measurable relationships, where harmony between effort and result indicates natural flow, while calculated divergences reveal the presence of smart money conducting their due diligence process before major capital deployment. The spring emerges as the composite, man's quiet confession that supply has been exhausted, manifesting during accumulation phases as a deliberate probe beneath established support that transforms retail panic into institutional opportunity. This signature unfolds through calculated deception, where price violates the trading range on expanding volume, penetrating levels that previously provided safety and triggering stop-loss orders from discouraged holders whose conviction proves insufficient for the campaign ahead. The diagnostic power reveals itself not through the initial dramatic sell-off, but through the recovery behavior that follows, where price snaps back into the range with a narrow spread close, often within hours of the apparent breakdown that seems so decisive to untrained observation. Professional operators engineer springs through systematic necessity rather than theatrical display, using temporary weakness to verify that selling pressure has been absorbed, while simultaneously clearing the path of participants whose fear overwhelms their analysis. The follow-up behavior provides confirmation through the effort versus result relationship turning asymmetrically favorable, where retests of the violated level arrive on contracting volume and narrower spreads, each probe demonstrating that inventory continues flowing from weak hands to strong, at precisely the danger point where risk remains smallest and information proves richest. The upthrust serves as the distribution mirror, where apparent strength above established resistance triggers buying from breakout traders while providing institutions with eager recipients for their accumulated inventory. This maneuver exploits greed through manufactured breakout conditions that attract momentum participants, only to retreat back below the penetrated level as demand proves insufficient to sustain higher valuations. Both patterns capitalize on identical psychological vulnerabilities, where retail participants mistake temporary probes for permanent directional changes, responding to institutional examination as though it represented genuine market sentiment, rather than systematic verification of opposition strength before major capital deployment. The no supply and no demand test emerges as institutional testimony delivered through whispered absence rather than dramatic presence, manifesting as narrow spread bars that close favorably within their ranges, while occurring on volume conspicuously diminished from recent activity. These quiet signatures reveal the market's most honest communication, where the lack of selling pressure near support during accumulation phases speaks with greater authority than theatrical volume spikes that capture retail attention. During distribution, the corresponding absence of buying interest near resistance provides equally valuable intelligence, confirming that demand remains inadequate to sustain higher valuations while institutions complete their systematic transfer of inventory to willing participants. Effort result: anomalies at critical structural barriers demand sophisticated comparative analysis that measures current volume and spread relationships against previous attempts at identical price levels. When substantial effort fails to produce expected movement through established resistance or support, absorption rather than rejection typically explains the phenomenon, revealing professional operators quietly gathering inventory while public participants interpret the stalling action as weakness. Conversely, light volume penetrations of significant levels that immediately fail to follow through indicate testing of commitment rather than genuine breakout attempts, where smart money probes the opposing side's conviction without deploying meaningful capital to the examination process. The backup to the edge of the creek provides final structural verification after successful range breakouts, appearing as controlled retracements that test breakout levels on contracting volume with narrowing spreads. During accumulation phases, this manifests as measured pullbacks to form a resistance that now functions as support, where price approaches the tested level with diminishing effort before finding rejection and resuming advancement. In distribution scenarios, rallies back to the underside of former support demonstrate identical controlled behavior, confirming that the structural change remains valid while demand proves insufficient to reclaim higher ground. These patterns complete the institutional examination process through time-price harmony rather than dramatic spectacle. Market testing succeeds through psychological warfare that exploits the fundamental architecture of human decision-making, where ambiguity becomes the weapon and time serves as the amplifier that transforms rational analysis into emotional capitulation. The tape presents institutional questions disguised as price movement, then waits while hope, fear, and ego negotiate against logic until poor decisions volunteer themselves at precisely the moments when professional operators require willing counterparties for their systematic campaigns. The hopeful trader emerges as the market's most cooperative victim, interpreting every controlled pullback and spring as salvation rather than examination, holding losing positions through clean institutional probes while abandoning danger point management in favor of psychological comfort. These participants mistake the composite man's calculated absorption for impending reversal, allowing optimism to override systematic analysis as they expand risk beyond acceptable parameters, rather than acknowledging that apparent weakness often signals the beginning of professional accumulation. Springs and backups register as rescue rather than tests, because the mind prefers relief to measurement, transforming tactical probes beneath support into narratives of imminent recovery. The fearful trader operates from the opposite edge of identical psychological vulnerability, cutting profitable positions at every minor retracement while interpreting no supply bars and effort result anomalies as threats rather than confirmations of institutional interest. These participants cannot allow cause to mature into effect because uncertainty feels like hazard rather than opportunity, forfeiting carefully accumulated structural development that required weeks of professional preparation. Their terror of surrendering paper profits transforms systematic position management into reactive decision-making that serves smart money by providing liquidity at precisely the moments when patient capital proves most valuable. The egoic trader completes this trinity of destruction by seeking intellectual validation over profitability, attacking testing signatures without proper structural context, while confusing manipulation with opportunity. The tape becomes an opponent to be defeated rather than a ledger to be read, and the market obliges by converting each premature stance into systematic trap. These participants fight institutional communications instead of interpreting their messages, allowing the need for being right to override the humility required for sustainable speculation. Wyckoff's remedy operates through procedure rather than motivation, demanding phase identification before effort result analysis, structural location before rule application, and written invalidation criteria before position entry. Discipline becomes the edge that manipulation cannot counterfeit because it expresses itself as repeatable behavior under pressure rather than opinion about where price ought to travel, separating identity from outcome while recognizing testing as invitation rather than personal attack. Mastery emerges when traders cease arguing with the tape and begin translating its institutional communications, accepting that market testing represents systematic invitation rather than personal sabotage. This transformation requires recognizing that the composite man's apparent cruelties serve as due diligence performed in public, where each dramatic probe provides verification of supply and demand conditions rather than confirmation of individual inadequacy. Discipline becomes the instrument that converts noise into signal, because systematic process, not emotional opinion, governs survival at the danger points where information proves richest and risk remains smallest. The operational framework demands elegant simplicity through methodical application. Identify the structural phase as accumulation or distribution. Locate the critical obstacle as established support or resistance. Observe the testing signature as spring, upthrust, no supply anomaly, effort-result divergence, or back up to the creek, then act only where invalidation criteria remain clear and measurable. Each position reflects Wyckoff's principle that cause precedes effect, requiring patience proportionate to the structural development that produced the opportunity while allowing time to convert institutional preparation into directional movement. This systematic approach transforms the trader's relationship with volatility from adversarial audit to collaborative intelligence gathering, where violent probes cease representing personal affronts and become verification processes that reveal absorption patterns and commitment levels. Heavy volume producing minimal progress indicates institutional accumulation rather than bearish confirmation, while light volume thrusts expose testing rather than genuine breakout attempts. The market's examination serves dual purposes of eliminating weak participants while confirming strong institutional interest, creating asymmetric opportunities for those who interpret testing as business transaction rather than emotional conflict. Sustainable competitive advantage emerges through disciplined adherence to predefined rules that honor the message over the feeling, placing stops beyond invalidation levels while targeting objectives that reflect built cause and structural context. Nothing gets chased by hope, nothing gets defended by ego, and everything receives adjudication through effort versus result analysis that measures current behavior against previous attempts at identical price levels. The greatest deception transforms institutional communication into personal failure, but this illusion dissolves when apparent sabotage becomes systematic verification, confusion resolves into clarity, and the path of least resistance reveals itself to those who trade the level and signature rather than the narrative that emotions construct around price movement.